All right, we are live. This is Wednesday, January 28th. Thank you, everyone, for joining us today on another IRSMedic Podcast. We have Keith Redmond with us and the great John Richardson. John, you know the question I'm going to ask. Do you have it ready? 32-ounce McDonald's coffee. We are powered up the most robust tax discussions right here. Thanks for joining us on IRSMedic. And so I want to welcome my great guests. We have Keith Redmond with us today. Keith, you're in Washington right now. You're dealing with this Canadian weather as well.
Yeah, I'm in Washington at the present time, and it is bloody cold and icy. Yeah.
Yeah, and I'm in Connecticut. We are dealing with this Canadian weather up here. But John, in Toronto, how are things up there in Toronto for you?
They had a lot of snow a few days ago, but it's not really that cold. Toronto's not particularly cold.
Okay.
You get out of Toronto not too far, an hour or two, and it can get very cold quickly. I don't know. Maybe it's because it's on Lake Ontario.
So you don't get as cold as Montreal gets, generally speaking.
Oh my God, there's absolutely no comparison.
Okay. I didn't know that. Okay.
Well, there you go. I just learned something about our great friends to the north of Canada. Or there you go. So Toronto's a little bit better.
It's really amazing. It's almost like a little carve out, right? I mean, I'm not saying it's warm. It's not, but it doesn't have that kind of cold that Montreal, Ottawa, or like Winnipeg. It was minus 40 there, I think, yesterday. You can imagine.
Jesus.
Edmonton, some of the coldest experiences I've ever had in my life have been in Canada, but not in this area.
Okay.
I remember in Edmonton once staying in a Westin hotel. It was so cold outside, the hotel couldn't even heat. Like it was
Wow.
Well, this was a Westin.
All right. So I think this sets up our discussion perfectly. So
Vancouver,
let's think about.
It's very temperate right now. I mean, I know people in Vancouver who, are sort of observing on the news what's going on in the rest of the country while they're out, not walking in their shorts, but But then,
it's a
Vancouver. You get up to Whistler, some of the best skiing in the world. So it's all over the place.
Oh yeah. So it could be true. You could have a Canadian who says, you know what, enough of this cold weather, and instead of going to Florida, they say, you know what, California is my place to go. Right. And we're saying, hey, hold on a second there. You just might want to watch out first. Might want to watch this video to the end, because the topic we're going to be discussing today is California, basically what I call the IRS of states, is proposing a billionaire tax. And California does some wild things. And this is the thing you need to understand about California. They really are possessive of certain people that come to California. They really do believe they have an ownership interest. Oh, 100%. It's really something. And so, we've seen, by the way, this is a whole, there's a whole cottage industry in California to help people with residency audits. This is how it works. Someone's in California, leaves. Then California says, well, you didn't file a return. There's a default assumption. You have to file a return. You didn't, so we're going to get you. We're going to chase after you. And there's people who have to fight tooth and nail to prove they don't live in California. California is one of the worst states. And there's other terrible ones. Virginia, Maryland. Keith, you have a little experience with Maryland. You want to just share a little bit about what happened there?
Yeah, well, I mean, they had said that for a number of years that I needed to pay Maryland tax because I had a Maryland driver's license. So they insisted that I was a resident of Maryland. Yeah. So they were going to assess me a major tax bill. And with the help of the great John Richardson, he wrote up something for me. And John, you can correct me if I'm wrong, but you explained in the write-up that I sent to the Comptroller of Maryland the difference between domicile and residence. And whatever you wrote, which I can't remember right now, worked. And the Comptroller actually called me. He actually called me and said to me that no problem, we'll waive it, but in the future, be very careful. This is what he said. Be very careful about, one, maintaining a Maryland driver's license, and two, be careful in how you vote on your when you vote in U.S. elections, that you only want to vote for top line federal like senator or representative, but you don't want to vote for referendums or anything like that, because that will give an indication that you're living in Maryland. So
Yes.
that's my experience.
Yeah,
Maybe,
there it is.
I don't want to go off topic, but if it is appropriate,
Well,
maybe John can elaborate on domicile and residence. Anyway, that was my experience.
Yeah, it's not off topic. Yeah, I mean, I don't remember that all that well, but what you're seeing seems to me consistent with it. I would add, though, one thing on the voting issue, and that is that there's a large number of U.S.-born people outside the United States who have taken the position that they lost their citizenship because they committed an expatriating act prior to 2004. And should those people get conned into trying to vote, okay, it's going to completely negate that argument. So, I mean, as time goes on, there are fewer and fewer people in that category, but I have had enough times so that I remember this, right? Instances over the years where somebody has, they've been living outside the United States for, whatever, 30, 40 years or something. And they're saying, well, I lost my citizenship by becoming a Canadian or something like this. This would be prior to 2004. But then I got all excited and decided to vote, right, based on a U.S. birthplace. And that fact of voting, absolutely deep sixes the argument that you lost your citizenship.
For the privilege of voting. Right?
Yeah, that's true. That's true.
I mean, we did a podcast on that once, I think, Keith.
Yeah, no, we did cover it, and and we have covered this a little bit more. And for those of you listening, looking for a solution, and this is what I recommend to people: if you are leaving, if you're going to leave one of these states like Maryland, New York, California, that tend to be incredibly aggressive in insisting that you're still a resident of that state, what I suggest is, a great way to defeat that assumption is to be a resident of another state.
Yeah.
South Dakota. I would just mention to people, South Dakota kind of has the best package where you'll get like everything done, an actual address, a license, a whole thing. So I would just, the cost is going to be about $2,000. That could be your best bet. I send people over to choosesd.com. That's where I go. Yeah, go ahead, Keith.
Yeah. I just wanted to I kind of touched on it lightly, and I don't know, John, can you explain a little bit further? Because when you helped me, you explained the difference, which took with the comptroller, the difference between having a domicile and having a residence, and that made the difference right there.
Right.
And could you explain what the difference
is? Well, Keith,
I
want to hold off on that.
Oh,
I think there's going to be a perfect time to answer that question because John gave me the regulations of California. I think we'll get into that. Be a great spot for us to get in there. I do want to get to John's incredible slides. I looked at these as these were already. So these are wonderful. So here's John's presentation. We're going to get into it right now. The 2026 Billionaire Tax Act in California. A justifiable wealth confiscation. So, John, take it away.
Well, I think, this is a very, it's a heated kind of discussion, and there are all kinds of different perspectives on it. But it reminds me a little bit of, watching the online world talking about Alex Preedy and Renee Good, who were, stated as a simple fact. I mean, they were shot and killed by U.S. government agents.
Yeah, they were murdered.
What I find interesting is that, one of the reasons it's hard to have these discussions is because people don't agree on a starting set of facts. And in the case of the shootings, I think a very reasonable, indisputable starting set of facts would be that 2 American citizens died because they were shot by U.S. government representatives. Okay, I mean, that is a fact. All right. Now, how you want to interpret that fact, it's up to you. I mean, you've got Christy Noem and company claiming that actually you almost get the feeling listening to them that the shooting didn't really take place, right? But I mean, the shooting took place. And say, well, these were domestic terrorists, right? I mean, we can argue that, but facts are stubborn things, and what we cannot dispute is the fact that U.S. government agents picked up firearms, pointed them at the U.S. citizens, pulled the trigger. Those bullets entered those U.S. citizens, and as a result, they died. This is an indisputable fact, right?
Right. Pulled the trigger 9-10 times. Yes.
Yeah, more than once. this is an indisputable fact. Here, I think it is an absolute indisputable fact to start the conversation that a group of California residents are trying to get something on the ballot to simply appropriate, I won't use the word confiscate, the wealth of 200 billionaires living in California. That is an indisputable fact, isn't it?
That is an indisputable fact. And this is what I would say, I specifically am not paying attention to any of the news in Minneapolis because it all seems like it's all trying to manipulate us into a particular action, which I'm always suspicious about, because the thing is, and what I always appreciate is people waking up to the fact that this federal government is your number one enemy. And it has been for a very long time. And the thing that this federal government has done is breathtaking. And we have this amnesia about it. And that's what drives me nuts. We have this incredible amnesia about all these horrible things this government does. Hey, every new election cycle, it's a refresh. Like, wait, what? We're going to just forget about everything evil that this government has done and how it is manipulated. And, killing us doing anything is not outside its realm. It is a terrorist organization that pretends it's not. And, this is where I always appreciate people waking up to the fact that this government is violent, it is angry, and it has no business ruling over us. It is a mob. And I think I have seen some of the footage, and I just would say, look, you're having mass, I don't want to say too much, but you're having mass guys run around with guns. That does not look like law enforcement to me, but what do I know, right? But right, we have these facts on the ground, and I think we have a very angry government that's part of it, and really looking, we have a government that really believes it owns us. And I think that is the lens. It can own us, and if it wants to blow our brains out in the street, it can, right? That's kind of what we have. That's what you need to understand. If it just wants to pull you out of the car and blow your brains away for all reasons, no reasons, wrong reasons, it doesn't matter. It can do that. It will do that. And there's pretty much no accountability, because rather people do that and to end up getting promotions. So that is really what we have to get. I think that's
clearly true of the current government. I mean, facts are stubborn things. This is what is going on. Nobody can change that fact, right?
Yeah, that's
but
right.
Violence,
So I think it's like looking at this stuff through, these taxes through just, hostility. And look, I haven't even looked at this, John, but of course, in my mind, I'm like, okay, here's how billionaires can, here's how billionaires can easily escape this tax. It always works every time. Give me a break. I'll tell you this. I already know, like, as I'm going through, like, the best tax shelter, I'm going to go through my head. A lot of you guys know what it is. And as you're going through this is what I would say for those of you, who know this, David, if you're listening, the private placement life insurance policy, think about that. If someone's in California, would this wealth tax possibly impact them? Think of that in the back of your head while we're going through this. All right. So I'll get to the first slide. Hey, there we go.
Speaking of it's interesting. I mean, so much of history is, written in terms of taxation, but taxation is always written in terms of, the divide between the rich and the poor. And apparently the date was November 7th, 2017. And basically there was mob rule in Russia. And what they did was essentially I think they killed the Tsar.
I think 1917, bud. 1917.
Sorry, yeah, 1917. Yeah. Not much difference.
Yeah, no, it's kind of the same. You're right. You're actually right.
Think about it, but I've often thought that the reason that kind of violence happened was only because Russia didn't have a tax code or a tax culture like the United States, right? I mean, really, what's happening is this group of people in California is trying to do exactly the same thing, right? But they're trying to do it through this wealth tax.
And I mean, this is, I think of, having a Bolshevik up is really important. And I'm like, I'll just put this one out there because it's a big leap for a lot of people, and I won't say too much. But I would say the United States had a Bolshevik revolution much earlier than Russia did. And if you know who supported Abraham Lincoln, then it starts to make sense. That's a big leap for a lot of people, but I'll continue on. But the Bolsheviks.
General point here, Anthony, is this: that inequality upsets people. What upsets people incites people, and what incites people often results in mob rule and violence. And that was clearly what happened in the Russian Revolution, and that's what's happening in California today.
Well, I mean, you're having foreign money come into Russia, right? Yeah, I mean, foreign money came into Russia to create that Bolshevik revolution. Donald Trump did say something about a foreign invasion on Joe Rogan last year.
Anthony, keeping that slide up, we could easily change the slide to December 22nd, 2017. The U.S. government confiscates the assets of Americans abroad through the transition tax.
Yeah.
Maybe
that's what I'm saying, John. That's like, yeah, I know you're off by 100 years, but you're really not, because we're living under the same regime. I'm not
off at all. Go to the next slide.
Yeah, you're not off at all.
As Mark Twain would say, history doesn't repeat itself, but it often rhymes. So clearly this rhymes. And I think the issue is not, is this a confiscation by mob rule? It is. Okay, I think you'd have to agree with that. The question is it a justifiable confiscation by mob rule, right? That's really what the issue is here. And you know, reasonable people, I suppose, can differ on that. But my point is, look, let's not hide what's going on here, okay? And can you imagine? This is absolutely shocking, and it's well, I would use the word depravity. Maybe others would say it's goodness, it's efficiency, whatever. But you know what's going on here, right? Is that a majority of people are banding together to confiscate the wealth of 200 people in California, and they make this clear. Next slide. This is the effect. It is the effect, but it's also what they clearly state. So I think that you can almost, I'd like to tell this as a story 100 years into the future. Okay, what happened once upon a time in America with taxation is destiny. So here we go. Once upon a time in America. Next slide. By the way, we'll come back to this later, but you try leaving California, okay? You know, as we know, very difficult. Next slide. Yes. Come back to that later. Okay. Yeah. So, historical note. By 2026, the United States had perfected the art of asset seizure by taxation. It's an evolution in society. And this is what, so we have this law, right? You know, it's proposed in California. Here's a Section 2R. The damn thing actually says, look at this. This is so.
Oh my God. This is amazing.
100 billionaires who collectively possess this, they state upside down, sideways, and diagonally, they intend to confiscate the assets of 200 people in California, right? It's very clear. They say it. Okay. Next.
Well, I just want to, it's like these billionaires pay less than 1.5% of their total wealth in annual taxes, including federal, state, and local taxes, according to leading economic estimates, a small fraction of what ordinary Californians pay. Well, wouldn't this be a whole argument of like, yeah, let's stop this, because every time you try to go after wealthy people have options and attorneys. But no, we're not going to learn that. Hey, look, we've been trying to squeeze these, and according to their own math, they're failing miserably because, again, let's think, guys, if you know the shelter we're talking about, it doesn't apply to them. So, amazing. All right.
They go on. Look at this. This is their language. Where they talk about, the justification. There are 19 million taxpayers in California who are not billionaires. These people, they always list the same people: nurses, teachers.
Oh, right, yeah, it's always right. It's always the hardest working nurse.
The salt of society, right? They're not billionaires. Blah blah blah. Now, what they go on to is they don't talk about income. They start talking about wealth, and what they're really saying, they're trying to provide the justification for why there should be a wealth tax, right? They're saying, well, somebody like Keith or Anthony or John, all of these people, they pay a very high percentage of their net worth in income taxes every year. Well, it's pretty easy if you're, dirt poor, right?
Well, I will also say this, but just quickly, I would say a property tax is already a wealth tax. So, we already have it. But anyway, continue. You're getting killed in California.
Notice who they're citing: Gabriel Zuckman, all these pension intellectuals, right? If you want justification for confiscating the wealth of anybody, just find a pension intellectual.
This does look like it's written by AI, I just got to say, because they have the trope. They have the trope of, oh, yeah, the hardest working Americans, right? The great California on the side of regular Americans.
Anyway, continuing here.
Oh, God, it's rich. There we go. Right on. Here we go.
They have to do this. So listeners, we're sitting around a campfire. So the first thing that was happening was California was worried about some claim that this might be unconstitutional. That is, could the appropriation of the assets of 200 people somehow be constitutional under California law? Well, good God, maybe we better begin by amending the Constitution. So the first thing they do is they amend the Constitution. Here we go. You can't make this up. So here's the new edition of the California that says this section authorizes and enables a one-time tax on the accumulated wealth of California billionaires imposed on those individuals who are California within the meaning of, these are just the tax residency rules, right? Now, you know, this is really amazing. Now, first of all, Anthony, I want to ask you a question, Keith, a question. Do you believe that it's going to be a one-time tax? More written fiction.
Well, the follow-up question is do you believe it's a one-time tax that will only apply to billionaires, right? Let's see here.
Hold there. Now, one of the best books ever on taxation, David K. Johnson, Perfectly Legal. Regardless of what you think of his politics, I think his book is great. He has a fantastic chapter. Fortunately, it's a relatively old book. I think it's over 20 years old, but he has a fantastic chapter on the birth of the alternative minimum tax, which is the same kind of stuff designed to go after a few hundred Americans.
Oh, yeah, the AMT.
Anthony, I'm going to make a statement, true or false. A class tax always ends up becoming a mass tax.
Oh, there we go. There we go. There's a quote. A class tax ends up being a mass tax. I think we need that. Wow. Yeah, that's absolutely right. And that all we have is history. Every freaking time. That's all we have is evidence that you're right.
That's right. And people sitting around the campfire. And yes, people, this was not the first time. In the 60s, the U.S. Congress amended the Internal Revenue to go after a small number of Americans who they viewed weren't paying enough tax. And today,
yep, and I know we are going to get into some of the common law discussions, guys.
Right,
I want to get through John's presentation, so
all right,
we'll get that.
All right, there's a link to the actual text of this.
I do have a screenshot of that. We'll go through that as.
But anyway, that's where it is. Next. Okay, now. Here's the thing. One of the things that's interesting about this, Anthony, Keith, question for you. Was the transition tax retroactive, yes or no?
Yes.
Absolutely, yes.
Okay. 1986.
Now, how many years retroactive was it?
So 17, so that would be 39?
That would have been, well, let's see, 2017 was when the TCGA thing.
How about 31 years? I'll make it real.
31 years. Sorry. Thank you.
Was it 31
years?
Okay.
Now,
that's right.
Interestingly, in the Supreme Court, they never argued. They abandoned arguments of retroactivity, which I believe was a huge mistake.
Totally. Yep.
Okay. So the Moore case, all right, upheld the tax, but didn't get into the issue of retroactivity, and who knows where it could have gone. But here, now, I want you to look at this. So this tax is going to be based on valuation of December 31st, and the obligation is January 1st. Question. This isn't law yet, by the way. Would that be a retroactive tax, do you think? Yes or no?
Absolutely.
We're after January 1st, aren't we? I have trouble with years, obviously. In fact, I have trouble with centuries, we've learned, okay, from the first slide. But you know, clearly this is a retroactive tax. Now, I think that probably, you know, my general understanding of the law in this situation is that you can go back within the year, et cetera. But you can be sure this will be challenged on the basis of it being retroactive. Now, also, who does this apply to? Residents of this state. Okay, and that would going to be residents of the state clearly as of January the 1st. At least that's how I read it. Okay, but residents, and we know how hard it is to escape the Hotel California, right? I mean, who knows? There are people who haven't lived in California for 10 years. They might have tried to collect this billionaire's tax.
Yeah, definitely.
Wow.
Yep.
So here we go. Now, by the way, to ensure political support, this applies to any tax resident with wealth of 1 billion or more. So, obviously most people now, except I know Keith has $1 billion. Okay. I mean, it's a good thing you're not in California, Keith, right?
Don't tell anybody.
Okay. But I mean, so this is just, this is pure, let's go after the hated few, et cetera, et cetera. But we're going to come back to the problem of proving you're not a tax resident of California. I mean, this is going to be big litigation. It's going to make the Keith Redmond saga.
I don't know. I mean, I've been thinking about opening an office in California. I don't know. I mean, I could, my brother's in San Jose, it's a beautiful road biking up there. Yeah.
All right, next. All right. Okay, now, remember, what does it mean to be an American? All right. Americans are reporters. They are reporters. And an American understands right from the first grade that their job as an American citizen is to report early.
Oh my God.
Yeah, and that's a quote from John Richardson.
What's going to become part of the law? Every Californian has to declare effectively, minimally whether they have more than 1 billion, but I read this as they have to declare their net worth. Now, this, I think, should affect all Californians.
Yeah, right. I love how the billionaire tax you're going to have. And now, John, do we know what the penalty is going to be when you don't file? Have they put that out there yet? Or is that going to be more of a little surprise?
I would think it would be the death penalty. I mean, this is America, okay?
So if you don't file the form, you should get the death penalty. Yeah, I mean, I would say so.
Absolutely.
Financially. So again, the billionaire tax that applies to everyone because the default assumption is you're a billionaire. That's essentially what it is. California is creating a default assumption you're a billionaire.
It's not a default assumption. I wouldn't go that far. It's just that you have to prove that you're not, or you have to say that you're not, right? It reminds me a little bit somehow in Toronto, they have this vacant home tax thing. So every year, if you own a property, you get this letter from City Hall saying, declare whether your house was occupied. They're not yet asking by whom, but it reminds me of this type of thing, right? But anyway, so look at this. I mean, so you have to, you have to report, declare we're worth less than or equal to 1 billion, and by the way, this is going to be expanded to list all your assets and exactly what they are. Guaranteed.
Absolutely. No. And I would say this, I think years ago, like, oh, come on, this law is not going to go anywhere. But no, I mean, this is what they're racing to do. Are you kidding me? This is their number one priority to pass this. This will happen. I mean, they're going to do it.
There we go. Report early, report often, report everything. This is going to be a great new industry. Can you imagine? People are going to be setting up shop as the California Wealth Tax Reporting Service.
All right. Well, and I just want to go, and there's something in here, and there's a word in there that I really want to kind of tee off on later. And this is the thing: when we look at along with any required appraisals or other evidence of fair market value, I'm going to hit on that later. That's what I want to harp on. That really bugs me, and I'll discuss that a little bit more in detail. I was doing a little research this morning on that.
I mean, Anthony,
but anyway, let's continue. I don't want to disrupt the flow here.
But I mean, one thing that's interesting about that is, just go back to that slide for just 1 second, please.
Yep.
This makes it clear there's going to be a huge cost of reporting on this, right?
Oh my God, right? Yeah, you're going to have to certify appraisals, and who's the definition of a billionaire? Well, what if you're 900?
Well, that's exactly right. And by the way, the tipping point is 1 billion to be subject to the tax, but you're not exempt from the tax on that first 1 billion. Okay. We'll get to that in a second.
Oh my God! No! Oh my God! All right. This is. I mean, California is amazing.
Isn't this great?
Amazing.
Okay. Next.
Yeah, I mean, they used to put that creativity in this thing.
Who's a resident? Now, this is going back to the discussion that Keith started earlier. Now, this is, I've got the link to the actual reg there. It is.
Yeah, and actually, that's what I want. And I just want to do, because I was sort of, looking at the reg before, John. I'm going to just want to switch over to the screen share of the reg here.
Before you switch, okay,
Yep.
let's get the operative principle down, right?
Yep.
The operative principle. Now, let's think about this, Keith. Does this sound like Maryland at all? The term resident is defined.
Yeah.
Now notice. Now I want you to notice. Okay, the word is includes. Every individual who's in the state for other than a temporary or transitory purpose. That's the first thing, right? That's a sort of a substantial presence type test. But I want you to notice that they seem to be able to, it gives them a lot of presumptive discretion, right? To decide whether this is temporary or transitory, for example, right? And two, now this is interesting, every individual who's domiciled in the state, who is outside the state for temporary or transitory purpose, right? All other individuals are non-residents. Now, this leaves a lot of room, okay, in a lot of ways, right?
Oh boy, that does it, right?
It's really, this is almost shocking to the extent that it would allow the California Tax Board, for example, to decide that somebody just happens to be domiciled in the state, right?
Yeah.
Now, I would say this, I don't want to dwell on it, but sort of the lawyer in me just had this thought. There are different definitions of domicile, et cetera. So I presume you're using some California, but this, this is interesting. All right, if you want to go over to the reg, look.
Yeah. Let me just show you. And this is what I was kind of laughing at when we were talking about Canada this morning, when we're talking about Toronto. Because California actually gives an example here too. Their X is domiciled in Quebec, where he lived for 50 years and had accumulated a large fortune. However, X's doctor ordered him to California, where he now spends his entire time, except for yearly summer trips of about 3 or 4 months duration, to Quebec. X maintains an abode in California and still maintains and occupies on his visits there an old abode in Quebec. Notwithstanding his domicile in Quebec, because his yearly sojourn in California is not temporary or transitory, he is a resident of California and is taxable on his entire net income. Some things that bug me here is like, well, what's the deal with that? Why is that relevant? Why is the accumulated large fortune relevant to that?
Well,
wow, it's like these regulations are before this wealth tax, so it's like, wow, they kind of like built the groundwork, it seems like, huh? They've been building the groundwork. So, that is just...
Anthony, first of all, I am not even sure. I don't know what the tax statute is in California. I don't know if it would include foreign tax credit provisions or not, right? California sucks. We end up with a lot of problems in California because there's not mismatches on tax credits. In other words,
we prefer clients not in California. They get hammered with foreign income. It sucks.
It sounds to me like a recipe for double taxation. California is not regarded as bound by U.S. tax treaties. Okay. Anyway, yeah.
Oh yeah, that's right.
That's right. Yeah. So you've got that problem as well. Look, I think for anybody listening to this who wants an intelligent piece of advice, stay out of California. Okay.
Yeah, no, it is really, really terrible. And it's gonna happen. Look how bad it is. Why wouldn't they do this? This is who they are. They've told you. They've laid the groundwork. They're laying it now they're laying the ground. Oh yeah, it's just the billionaires, just like the income tax. Hey, look, guys, it's gonna be a 1% tax on
I had a client sometime in the last few years. This wasn't what I was helping them with, but as part of the discussion, they told me that they'd lived in California and moved to Europe. That they had 20 years earlier, and that they'd recently received a letter from California about income taxes. Okay.
Yeah.
So California is a real problem state, right? Now, while we're on this point here. People do have short memories. And 3 or 4 years ago, California was proposing an exit tax moving away from California, right? Now, this is a wealth tax, okay, based on California residency, but I would not be surprised if not only do they have this, but they try to reactivate the possibility of an exit tax to put people in a position where they either pay the wealth tax, or if they try to exit, they have to pay an exit tax.
No, and I think that's exactly what they're setting up. Just back to this slide here. I think, John, that's exactly what they're setting up because of the form. They're going to have the data on how much you've been reporting, and then the wealth tax the exit tax will, oh boy, watch it creep down, and then it'll be an exit tax as well. They're clearly doing that. They're setting up the entire background. The California Franchise Tax Board, as terrifying it actually is somewhat of a well-run organization. It can do a lot of things, and I'm gonna.
And Anthony, every American citizen needs a full-time lawyer, right? Every family
Everybody does, right? Every American citizen needs a full-time lawyer. Absolutely.
Anyway, all right. So continuing on here. Oh, and back to our story around the campfire. Yes, the tax priests of the day, the just-in-time historians, made the point that, and yes, it was hard to sever tax residency with California. Okay. You might want to pull up that tweet in the bottom.
I can't. You know what? I can't get to that. I can't. Yeah.
It's really interesting. It's not impossible, but it's very difficult to sever tax residency with California. And I think that even middle class people probably should get some help with that. It's, something that, in my view, needs to be planned well in advance and done systematically. But anyway, next. In other words, you do not just pick up and leave and claim that you're no longer residents in California. Okay. Next.
Here we go. All right. So here we go. All right. Computation. Oh, here it gets fun.
Now we're into, let's say you're caught by this. Now, how do you calculate net worth? Now, this, by the way, presumably is for the purposes both of determining whether you meet the $1 billion threshold and what it would be should you be subject to the tax. Now, this is really, really interesting, particularly from my perspective as an expatriation lawyer, where I deal with, how to think about asset valuations all the time. And what's interesting here is they're laying out a lot of very specific valuation rules, and I would not be surprised. I think people who want to renounce U.S. citizenship should get at it, because the 877A rules direct Treasury to make regulations, and I could easily see these California regulations as at least being considered as possible models for how to evaluate assets.
And I'm going to get into and it's absolutely insane how they do this. And
net worth is assets less liabilities. Anyway,
right? And you say it's like has genuine debts, right? Well, what you have a debt, but we're going to say it's not genuine. And then there's limitations and carve outs. So what that tells us is they're not going to actually take into account your balance sheet. They're going to invent they're going to invent a definition of net worth, a statutory definition of net worth that is that serves their purposes. Hey, look, you're not a billionaire, but you're a billionaire according to us, right? Billionaire, you gotta love it.
Exactly right, Anthony. And part of the problem with this type of tax is a liquidity problem, and I'll get to this in a minute. But a 5% tax, that almost sort of assumes that all your wealth is in cash. You're going to have to sell things and generate capital gains to pay that.
Exactly. Borrow.
Be a 10% tax, right?
Yeah,
Not only if they're going to get the 5% on the wealth tax, but they're going to get the tax that results from the forced liquidation. This is the purest form of evil imaginable, right? Next.
Yeah. So here we are.
Now, doesn't apply to real property. Now, I'm not, living in California, I don't know a lot about this, but I know that there are constitutional problems with taxation on property there. So I think real estate. So I think that may be directed at this a little bit. Now, anyway, they've exempted real estate as a general principle, provided that it's in your name. Okay. If it's not in your name, if you've moved into a trust or something, all bets are off. If it's in a grantor trust, now this is fascinating, right? So a grantor trust, the Internal Revenue Code is where the income from the property is taxed to the grantor, okay? But the actual property is owned by the trust. So what they're trying to do here, right, is pull back into net worth stuff that you don't own under trust laws, okay? I mean, this is unbelievably depraved, okay?
Wow, they got to just do it. I mean, they just want it. Look at what they're doing. Really crazy. To the extent of valuation of real property is required, the value used for calculating the property factor, what the hell's a property factor, of the corporate income tax well, there you go. Wow, that's very, whatever that is. Okay.
Anyway, basically, all right, so what would you do, right? If you're a billionaire, what you would do is you'd put it all in land, right? That's how you would avoid, well, I mean, you're caught by it now, whatever, but it's very interesting that, they leave out real estate. Next slide. They also leave out pensions. Okay, pensions, and this is very interesting because the federal exit, the 877A, does not leave that stuff out. This is
well, California employees have a really nice pension, so why would they? They're not going to do that.
Billionaires either, but anyway, next. I talked a little bit about the trust issue. This is going to be hotly, heavily litigated. Next. Now.
Yeah.
So, you talk about whether, what's a fair market value assessment. I mean, part of the problem with this is that, some of these, if these are securities and that, it's easy to look up on a stock exchange, but, how do you value as usual, privately held corporations, but they have rules for that too. Okay. Where they talk about, whether you're a minority interest, et cetera. I don't want to get into them, okay? But they have very, very clear rules to prevent the unreasonable discounting of the value of assets, okay? Next.
Oh, man, this is, again, there's just so many things wrong with their fair market value. We saw it in Roger Ver's case in his exit tax, where Roger Ver, if he sold his Bitcoin, he would have crashed the market. And the government had a problem with that. The government has a problem with market realities. Like, no. You just have to take the high price, but don't ignore. But you have to pretend when you sell your stuff, you wouldn't disrupt the marketplace. And so it's this fiction they create. These mark-to-market regimes are completely fictional. We see them all over the place. We see it in PFIX. We see it in the U.S. exit tax, where they're creating a phony. We even see it to a degree in property taxes, where they're given assessed value. No. Someone can't. No. If everyone sold their property, it wouldn't be worth that. And that's what we have. These mark-to-market regimes create this. They cherry pick something without the reality. So in fact, these mark-to-market values are made up. They're not real. You're looking at a market price without participating in the market. It's not valid. That's my big beef with all of these, and that's how they create these high values. And I mean, how many times I've come into clients who thought they had all this thing that was worth so much money, come to find out this massively jacked up asset. Hey, reality, dude, here's the buyer. This is what he's willing to pay. That's what you have. Yeah, I know the market here and this, and you're comparing that and that. And you see that with real estate all the time. You sell your house. Oh man, the market's doing great. What do you end up getting? It depends, right? And you might end up taking a lot less than what you thought the market was going to go, because the market is a fictitious value. There's no transaction. There isn't that transaction that exists. You didn't sell it. When you do a mark-to-market, you didn't sell it. If you sold it, the value would go down, because if everyone sold who's subject to these regime, they are all depressed. And that's where the government, again, this is how they steal, right? Flat out stealing.
This is an aspect of this that will be very heavily litigated. It is also what I foresee, okay, is litigation over whether somebody has $1 billion in net worth to begin with based on this, right? I mean, I think that anybody who's bumping up against who's bumping up against this should get legal assistance earlier.
Oh, now, yeah.
Okay, next.
What I would say too, and I would say, look, if I was, anywhere around over $15 million in net worth, I would be getting out, because that's where it's going. They're setting up. They're pitching it as billionaire, but man, I would get out.
Well, that's right, and that's that's where I think we go now in the conversation. I mean, the problem with taxing authorities is they think very short term. They don't think long term, and
they don't care.
This kind of thing, really is going to discourage a certain type of person from living in California, right? And, that's going to have a long-term effect on tax revenue, et cetera. I mean, look, the bottom line is this, okay? Somebody has to generate wealth in these states. And the problem is that if you essentially incentivize all the people who generate wealth to leave, what you're left with is, a bunch of people who need to be taken care of and are not generating wealth. We'll get to this slide in a minute. I found a really interesting 2023 Wall Street Journal article where, they were talking about this at that time. And one of the points they made was that the high tax states, California, New York, et cetera, are always running at a deficit, and the low tax states seem to run at a surplus, right? And, and the reason for this is that at least, it was hypothesized in the article. I think there's probably some truth to this. But basically, if you incentivize people who generate wealth to leave, what is there? There's just not enough left to tax. So, look, the solution to this is to have a fair tax system along the way and not perpetuate this grossly unfair tax system.
The solution is tar and feathers, and I think we were just ignoring. You essentially have, and I think this is what it is. We have, we don't have any rights. Essentially, what California is saying, your only rights left over are what we say you have. That's what California is doing throughout this until the people have no rights. It looks like they're steering something clear of real estate a little bit, but they're just, look, we are California. Not only do you have to worry about, really, it's just like essentially what's going to happen is just sort of a custody battle between California and the feds over who actually owns more of you. I think that's really, your best bet is to see, between the two, they're fighting over you. Who, now you probably have your local government too. But I mean, really, there's no real anything here. And how much, and I mean, the thing, and I think this is the price, assets have to be sold to pay the tax, or you have to borrow. It's one or the other. And you don't have the money because you don't have a sale. And again, it's the most favorable sales circumstances imaginable for the government. Clearly something by people who never actually participate in a market. These are people that are like, hey, we got our pension, that's what they have.
So Anthony, look, let's generalize the problem.
Okay.
Problem is that the wealth includes assets, and mostly assets that are not liquid. Okay. Therefore, there's no way to pay the tax without liquidity. That's what the problem is, right? They don't care. I mean, these people who promote these wealth taxes are, seriously disconnected from reality. Okay. I mean, they have a lot of trouble. They live in a world of sort of theory, right?
Well, I mean, I would say they're totally educated by the modern legal education system. I mean, that's really what they are. They're total robots.
They're all intellectuals anyway. Next.
Oh yeah. There's not, the people suck. Government rules. That's really what it's about.
All right. Now, again, that's the link. So now I'm shifting. We know how bad this is. Now, let's get back to the discussion of, historically, what does this mean, right? We're trying to put this in historical context. And, it's really, really clear that when things reach this point that they're forcing people out, Gavin Newsom, for example, I understand opposes this precisely for that reason. Why are we, getting rid of the people who generate so much in income taxes? And this is the problem, right? This is the problem. And the people who propose these wealth tax, like Elizabeth Warren or Gabriel Zucman, really, it's that they hate the wealthy more than they are interested in having fair taxation, right? It's more that, because I agree that wealth inequality is a problem. I do agree with that. But what you do is you solve that by getting a more rational income tax system.
No, I think the problem with wealth inequality is well known. It's usury. Usury is it. Usury puts the wealth of a nation in the hands of a few, and that's what we have. So that's the number one problem in our financial system is based on usury. So of course this is the logical consequence of our fraudulent financial system. And now it's just, hey, what left is there to steal? That's really where we are. And by the way, I do want to mention, guys, I will be uploading John's slide to the membership site. So all the links that you want, if you want to go there, I will be uploading this along with the link to the video.
I'll send you one with the century corrected if you like.
Okay, yeah, well, great. All right, so we'll have the corrected site. Just go to IRSMedic Podcast.
I'm trying to look at this, from the point of view of what's going on generally, right? So this is, and it's interesting because the Hotel California, that line, if you can never escape, why would you want to live there in the first place? That's actually from the Wall Street Journal article. Same thing with U.S. citizenship, right?
Yeah.
I mean, this is why you don't want to be a U.S. citizen. Next. General concerns here. Look, here's another very interesting article, written by, somebody who, I don't know, claims to be a billionaire. Anyways, he knows about, he knows these people. But it is a good article, and I would summarize it by saying that, the argument is, and I think this is absolutely right, there's no way it's going to be a one-time tax. It's eventually going to affect all residents' liquidity problems, very negative signaling for the overall business environment. See, income tax reform would not have these problems, okay? Or at least not to this degree. But outright wealth confiscations retroactively, that's a completely different kettle of fish. Next. Well, we're living in times, right? Or to go back to my story around the campfire.
Yeah.
Time in 2026 in the United States of America, the one thing that was perfectly clear was that wealth was an incredibly dangerous thing. And, it's interesting because, for a long time, I've, sort of been thinking about what does wealth actually mean? And, I think I've said this before. My personal definition of wealth is the ability to be happy with small amounts of income and few possessions. That is true wealth in this world. That's where you've got protection from all this stuff. And, and look, hey, you want some help with this? I can show you how to be poor and happy.
I think there's some amazing. I think there is absolutely some liberation in it, and absolutely no. And I'm with you, John. That I would say over the last since COVID, really, I have separated my happiness from wealth. You can't, good Lord, I have my idea of a good time is going into the woods with my friends and doing trail work, and I already own the shovel. So that's you can't take that away from me. You can't.
Anthony,
yeah?
I've got one question for you.
Yeah.
Do you own a Dodge Stratus?
I do not. But if I did, that would be a great vehicle to bring my trail work. Yeah, the four-door.
Dodge Stratus, Anthony, is the symbol of the new wealth revolution.
They don't want it. Own something they don't want to impound or take. Like, oh God, he's got to. Right there is. I would say that. I think what we're coming to is the Dodge Stratus sort of way to frustrate the government. Have something no one wants.
Exactly.
No one wants, and that's sort of your attraction to it. The fact that no one else wants it, that's giving you freedom. And now I see the Dodge Stratus does create this sort of this impenetrability. Now, if you're able to get your mind around and enjoy a Dodge Stratus, you are liberated. You are liberated from the constraints of the world. I would say I agree with that. And just find that thing no one else wants. And by the way, when the IRS goes harassing people, they always want to look for that lavish lifestyle. They're always looking for that lavish lifestyle, whether it's actually lavish or not. They're always looking for those elements of that to put that in the press release. But and one thing's like, look, if hey, here's a guy who lives in his car, and he hasn't been paying tax, no one's going to care, right? And that's kind of the 4-door. Yes, the 4-door. the 4-door Stratus, let's be practical about
It's
things.
only a 4-door. Don't you remember the ad, the greatest ad in the history of automotive marketing, right? This, this sort of low end, Joe Sixpack car. And the ad was, you're not losing a sports car. You're gaining 2 doors.
You're
right? I mean, it was incredible automotive marketing.
All right. I want to get into, all right, so I got to say, I do agree with John, and here's the conclusion. So, I mean, essentially, like, we normally talk about the U.S. exit tax, but I think there's going to be, I got to say, I can't trust California for anything. And now I think, now I just want to sort of go over, like, what is going on here. California is out of control, and now we're going to, Professor Stuffology, there's only 2 types of tax, direct or indirect, right? So what's this exactly, right? What's this?
No, I don't know. I mean, it doesn't matter. It's a confiscation. It's mob rule. That's what it is.
Well,
okay?
and I think it's, I think this is what we have is that and here's the problem. I think there's sort of a comment that Andy had up here. And this is the comment, Andy. This is the comment that sort of is making me sort of, like really think about things. Is that this is what we have? Okay, so in law school, this is how it works. You're taught, like, okay, look, what's the purpose of the common law? Well, when a statute is passed and the statute is silent to a term, we use the common law to fill in the gaps. Okay. And you're like, and that's sort of that is how the common law is presented to you in law school. And well, what if there's a conflict between the common law and a statute? Well, the law school will tell you the statute wins. Law school will tell you the statute wins. Of course, that's not at all what the understanding, that's not at all what the Constitution was designed to protect. The Constitution was designed to protect fundamental rights as established by the common law in 1789. That's totally what it was made to do. But we end up with this thing, and it's actually like this is what I'm trying to articulate here. It's like we end up with the worst of both cases, and it's sort of like, and I would say this, it's like the government gets to pick and choose your game. Hey, you didn't have that game, but we're going to hit that value. We're going to invent that. And then likewise, in these laws, the government gets to pick and choose. Well, we're going to claim, we get to pick and choose. We're going to go with the overall legal structure, which is all common law based. But what we're going to do is we're going to change the nature of that so much to completely pervert its process, to completely pervert it. And that's really what we have here. Is just, everything complete. There's nothing here. And I guess this is it, Andy. I'm like overwhelmed. Guys, I'm like overwhelmed with the amount of illegality on this. It's so bad. I'm stunned. Where do you start with this? Because there's multiple things. There's multiple maxims of law that would apply. Like one of them is like, well, if something's impossible, it's not legal. Forcing someone to pay a tax when they don't have a realization, because you're absolutely right, Rob. A capital gain requires a sale, right? And it's a private gain. And once that gain it is made, it becomes a property. It's private property that is subject to fundamental right protections. But again, the U.S. Constitution is sort of like, yeah, no, we're going to ignore that if it comes to our statutes that take your stuff. Hey, look, if it's our interests, if it's the government's interests, the law is different. That's what we have. We have a government that mixes and matches, and that's really the frustrating part, is that they're powered by the concepts of settled law. It's like they use concepts of settled law to overturn the world. They're committing it's an insurrection against the common law. It's an insurrection against the law. It's an insurrection against the people, and they're using the legal principles in order to do that at points. But then, and that's kind of thing. That's where the problem is, mixing and matching. All right, I know Keith has been patient there. He's been taking this in, and I want to get to him because Keith. So now you help a lot of people out around the world, and have you encountered people? Basically, you usually people, they're not in California, right?
No, I have. Yeah, I mean, this is a very good subject. but I have yet to encounter somebody who has had to deal with a situation like I had to deal with in Maryland, and about which you're speaking, in these states like California, New York, and Maryland. I haven't yet had to deal with that. Nobody has come to me in that particular aspect. It's more, the federal level versus
Yeah.
state level. I just kind of give some guidance as far as the do's and don'ts on a state level based on my experience and what the comptroller in Maryland shared with me, which I shared earlier in the podcast.
Well, Keith, and this is what I would say, because I know you talk to a lot of people, and a lot of the reasons why people reach out to you is that, hey, look, they haven't been filing taxes, U.S. tax, they're living overseas,
Right.
They haven't been filing taxes in years,
and years
now
or
there's
ever,
an inheritance or something coming on here, and now they're like, oh, Keith, what should I do here?
Exactly.
Now, could you do me a favor?
What's that?
When you're talking to someone with California, hey, I'm going to inherit a house in California. Just do me this favor. Is that this? Hey, look, even leaving this crazy exit tax aside, understand California is the worst state in the world in the probate process. Absolute worst state in the world. It's so bad. It's so expensive. It's so time consuming. It's
worse
so
than New York. Worse than New York.
Whoa, God, yeah.
Okay.
Oh, God, yeah. Yeah. California's by far the worst. New York, yeah, you definitely want to do something there too. But California is the worst. And I think one thing that people need to understand is that probate process. Again, the California, the legal system got a hold of it and created the law, and basically created the probate process as sort of as a way for attorneys to make more money. So really what you want to do is make sure that if you have property in California, you don't own it directly, because that probate process is brutal. You do want to have it in some sort of trust. That is just what I would want to say. If it is coming there, because, oh boy, it's just awful. You got to really, really watch that. So that's what I would just say is look out for that to anyone. It's just a nasty thing. You're like, oh yeah, I inherited a house. Okay. Maybe the first thing you want to do is put that house into a trust so you don't have to go through the pain that your loved ones went with. Yeah, and this is what we have. And so this is sort of what we have. It's like we have, our rights existed before any government passed one law, before the federal government passed law, before California became a state. When California became a state in 1850, we already had our fundamental rights. We already knew what it was. We already knew what a due process of law was. There wasn't one statute that created the due process of law. Not one. It already existed. What we have is legislative versions of our rights, which are always like the opposite of rights. Legislative versions always imprison us. They always ignore the fundamental rights. They always overreach, and we always can count on the courts to uphold that because they're all on the same team while claiming they're not, right? And I mean, can you really imagine this, John? You're going to go to a California state court to argue that you're not a resident in California, right? What do you think they're going to do?
Well, they're obviously going to, do their damnedest to take the position that you are. But, listening to you talk about it, I have a question for you. Do you think that the very foundational purpose of the state of California is to override individual and common law rights?
I would say so, yeah. And I would say that's, yeah. And I think that you can apply that to every state as well. Basically, they're all, that's what they all, every state ignores its constitution. Every state does. Every state, and it's just allowed because the judges are the ones who are part of it. They're in on it. Everyone's in on it. Hey, look, we got to get our pensions. Hey, we're state employees. And you know what? We're looking at they make a lot of money in the private sector. Look how good they're doing. We got to get some of that. Look at these guys, the envy, the greed. These people are nuts. And I mean, they're gold-plated benefits. I mean, California is obscene in how it compensates its public servants. Oh my God. A beautiful state, by the way. Just don't have anything to do with its government, and I think you'll be fine. I think and that's really what we end up with is that we do have two levels here. Look, if you're someone who's in the country illegally, you're fine. If you're someone who's law-abiding, hey, stupid, we got you now. We got you. You are stupid enough to be legal, whereas everyone else is illegal. And then I think this is one thing I want to mention here too. For some of you listen to me on our membership group. You know the names. I won't mention them on on YouTube. If you want to join me on our next membership call this Friday, I will. If you want to know the names, I'll tell you there. But I'm not going to say it publicly here. I know of 2 billionaire families. One is in New York. One had a business in Stamford. Okay. Both evaded taxes so blatantly and obviously it's criminal. But the IRS whistleblower protection exists to protect the really wealthy billionaires from tax evasion. Look, you don't need to be Hunter Biden to avoid scrutiny. You could just be someone else who's a billionaire. So it's kind of laughable when I look at these things and they're like, oh, yeah, we're going to come down hard on billionaires. No, you're not. No, you're not. They're already getting away with it through their special interests and their protection. And guess what? They're bribes. Yeah. Guess there's actually, you're not going to believe it, but there's corruption. I know, guys. You're thinking that this state of California is all on the up and up. But that's one of the problems with this as well. Whenever you see this going after billionaires, give me a break. Give me a break. They're lying right through their teeth. The connected billionaires get out of this. And if they don't get out of it illegally, they're fools not to get out of legally. I could, and by the way, I could tell you this right now. Private placement life insurance is not at all impacted by this whatsoever. Good luck, California. You're not going to get it. That's the thing. So if you are wealthy, you have a legal loophole. That's amazing. And then you have an illegal loophole that could even be more amazing. That's really what we have here. So that's kind of where you're better off illegal. Yeah, I mean, really, you're better off illegal. And that's what the government is trying to drive us to. And what does it mean to be illegal? I think it's being out of the U.S. financial system. They have no way to get you otherwise. Let's see here. We are about, oh boy, we're over time already. I did want to talk about what we're going to talk about next week. John, we didn't mention about you, but Keith and I were talking about our topic for next week because it came up. We want to talk about the idea of getting powers of attorney when you're overseas, and how to do it, what to do it when you need it, and all the other things that might be a little bit difficult when you're trying to, when you're going through sort of some of the estate planning challenges overseas. Does that sound like Keith said you would love the topic, by the way? So
I'm okay with the topic, but what is the date of next Wednesday?
February. What is it here? February 7th. No, hang on. I'm in the wrong month. Wait, today is February 4th.
Yeah, that's okay. Yeah.
Okay.
I'll be in Toronto that day. Yeah.
Okay, you'll be all right. All right, great. So next week we're going to cover powers of attorney and how they work for expats, and how you might want to not have a California power of attorney. Think about it. So for that now, and then again, so this Sunday at 9:00 a.m. I'll be having our weekly call. A lot of people will be joining us on that. I'll be going over some things.
Friday, you just said Sunday. Don't you mean Friday, Anthony?
Friday. Did I say Sunday?
You did.
Oh God. Thank you. Friday. Thank you.
I've contaminated you. At least you're in the same week, not the wrong century.
All right. Yeah. So yeah, Friday at 9:00 I will be a membership. So if you want to hop on there, we discuss things that aren't great for YouTube, like who's actually evading taxes on a massive industrial scale. You can find that out too. I'll share with that if you want. So you can join us there. Go to IRSMedic.members.com. You'll have John's slides there too. And now Keith has been quiet. He's been taking a lot in. But I do just want to point out for those of us, those you're checking in, just sort of like Keith, if you could fill people in on what's your role and why you have so many fans. I'm a huge fan of you. You have a lot of fans. So could you just explain to people about what you do a little bit?
Yeah, sure. Well, I'm the founder of the American Expatriates for Residency-Based Taxation group on Facebook, and there's about 12,200 people right at the moment. And it's to support residency-based taxation. But the other purpose of the group is to really explore all of your options based on your particular profile and experience. profile and situation. And that's what I do one-on-one with people where they don't know where to turn. They don't know what to do. They need to take a look at their situation as it is today and to put together a short-term and long-term strategy, again, based on their profile and situation. And that goes for, Americans overseas who are living permanently overseas, and whether their financial center of gravity is in or outside the United States, accidental Americans or anybody else that's, in a quandary on what to do vis-a-vis the U.S. tax system. So we go through all the real options. I mitigate the scaremongering and deal with the reality on the ground. That's the bottom
beautiful.
line.
Yeah, and Keith, I'm just looking at this post right here, and this is really typical.
And the last thing I'll say, and yes, I do have detractors, as you saw, Anthony. I have people out there who do not like me because I explore all real options.
Yeah, the tax industry isn't necessarily a fan of all three of us. Any three of us, maybe not 100%, because we are on the side of the people, not on ourselves, right? That's really where we are. And so this is really, this is really our. I mean, this is a typical thing. Someone who was lived in the U.S. from birth to 34, moved to Australia at 34, been there for 11 years, is now considering a renunciation. So these are the kind of people these are the real people that help. Sometimes Keith will send them over to me or John. For renunciation tax work sometimes.
And also green card holders, as well.
Yeah.
And also I do talk to people about renunciation and what that will look like and if it's necessary for them or not.
That's right. Yeah. And so if you are thinking of a move and not sure where to go, and I'm going to say this, maybe your first call shouldn't be to someone in the tax industry, because I could tell you what their answer is going to be. Right?
Yeah.
So maybe what you want to do is to send an email to Keith at US_overseas_advocate@outlook.com. So that's what I would recommend if you're thinking about doing it. Keith is a guy based in reality, and I appreciate that. He is based in reality with a heavy dose of humanity. Keith, I got to thank you for that. And likewise, I want to just, if you are thinking about renouncing your citizenship, which happens a bit,
or formally giving up your green card. Well.
You might want to reach out to John Richardson, especially if you have a tricky one.
Yeah.
If you got a tricky one, he's going to be you kind of want someone who's really at the top of their game. I would recommend him. And likewise for myself, when clients coming off of YouTube, it helps us create more content. And the more clients we have, the better content we can create. So I really appreciate all the people who come and also leaving reviews for Parent IRSMedic on Google. We've been getting some reviews there. We have our detractors as well. So we get sometimes fake reviews, people giving us negative reviews because they don't like what we're saying. It's wonderful. But again, if you are thinking about renunciation, you're thinking you got a tricky one, I can't think of anybody better than John. You can email him at citizenship-solutions@protonmail.com. And back to myself, I'm Anthony Parent at IRSMedic. You've got IRSMedic.com. We help a lot of people convert weirdly, even though tax is crazy, U.S. is terrible, and you hear me railing about it. As bad as the U.S. is, and California is really terrible, it still could be your better option than where you currently are. We're actually helping a lot of families. Maybe they have a business overseas in Europe, maybe in Asia, create a U.S. presence. There's many reasons for it, and oftentimes for evaluation for your cash out, this is something that you might want to do. We really enjoy helping global entrepreneurs, global families kind of come up with business and tax advisory for them, along with prep. But really, that's really our bread and butter. So if that's something that sounds like you can send an email directly. This is a niche site. I don't have to worry about too many emails coming to me. So just email at aparent@irsmedic.com. And again, I also started my membership group. The discussions are incredible. And this is what I would say. The people on the call are incredibly smart and keep me honest and know the arguments that I buried. And they're like, what about this, Anthony? So they're really, really smart. Something else. A great group of people in the membership site that you really might want to meet that may help you articulate some of your frustrations and really take a look at things in a way you never did before. If you want to know why the world feels so wrong, it's because it's wrong. And really, our government has overstepped its boundaries by so large degree. It's comical, right? All right. So for that, I'm going to sign off right now. This is Anthony Parrott for John Richardson and Keith Redmond. Thanks for watching, and we'll see you next week where we'll talk about powers of attorney when you're overseas. Thanks for joining us.